Moody is lowering its credit rating on the United States debt one notch to AA from AAA due to increasing government debt and interest payments.
Well, if it couldn't get any worse for the housing market, Moody's just downgraded the U.S. debt. This comes as consumers expect 7.3% inflation in the next 12 months. And Redfin just announced that pending home sales have dropped year over year 3.4%. What does this mean for the housing market? And if you are thinking about buying or selling, you're gonna wanna watch this. Now, if you do find this video helpful, it certainly would mean a lot to me if you clicked like. And as always, I love your comments. I enjoy and learn from them. We are starting to see an increase in purchase mortgage applications. So why is Redfin saying that pending sales are down? In fact, Altos confirms this, and even my data here in Nashville shows that demand is lagging national demand. It's down over 5%. Even John Burns Research Consulting is showing the headwinds hitting the new build market. Even with purchase mortgage applications, it doesn't seem to be translating into increased purchases yet. And the Moody's debt downgrade couldn't come at a worse time for the US government and pretty much anyone in the housing market. Because regardless of whether or not this directly impacts the markets, it's calling out the risk for higher interest rates. Higher interest rates, higher mortgage rates. And higher mortgage rates could mean an even more frozen housing market. Now, the last time Fitch downgraded the US debt, it was kind of a nothing burger. However, in the long run, it really doesn't matter. What Moody's is calling out is still a persistent issue. If the 2017 Tax Cuts and Jobs Act is extended, which is our base case, it will add around $4 trillion to the federal fiscal deficits over the next decade. The fact is that if the federal government is not interested in cutting their deficit, they're going to continue compounding that $36 trillion debt, and it's going to snowball. This is going to lead to investors wanting a higher yield if they're going to loan the U.S. government money. AKA the housing market will have higher mortgage rates. And this comes as active listings nationally are up 31%. In Nashville, they're up 35%. And the shift is happening in real time. If you look at this $1 million neighborhood in Brentwood, it's kind of frozen. New builds are getting a smaller market share as more and more listings come online in better and better locations. And even if the quality isn't perfectly new build, those locations are winning, especially in those houses that are checking all the boxes. They've been fixed up, they've been taken care of, and some of it has been renovated. Keep in mind, there's a lot of people getting a lot of interest from the federal government just by saving, and these are spenders. And that's led to certain neighborhoods to have even more demand. Believe it or not, for the first time ever, I submitted an offer this week in a multi-bid backup offer scenario. That's right. If the contract falls through, we were competing on being the number one backup offer. As weird as that sounds, that is happening in a market where inventory has grown 31% and demand is down 5%. The fact is, though, we're seeing fewer and fewer situations like that. Those situations are not happening everywhere, and they're becoming more and more isolated as the market becomes more and more hyper local. Here in Nashville, our condos are having an extraordinarily difficult time, especially resale condos. As the new build apartments converted to condos, they are sucking the oxygen out of the room. Condos are high risk. If you're going to make an offer on a condo, which many of them already drop 20 to 30% in value, be aggressive. Now, honestly, when something drops 30%, it kind of stokes my interest. Like, how much further can it go? Townhouses, many townhouse buildings, anything that's not unique and has been built in mass is struggling. Even the short-term rentals. A lot of the 4-bed short-term rentals they built in stacks. A lot of that was on Trinity in North Nashville, but we even saw it near Vanderbilt and some other areas in the nations. These are harder to sell now. There's just not anything that makes them unique. And because there's so much of them, they're competing for virtually the same number of buyers. Look at Illume. Illume was a short-term rental condo complex that has dropped 30% in value. Now, where's the bottom? Nobody knows where the bottom is, but what we do know is some of this stuff has already dropped 20 to 30%. Is it going to keep going? Who knows? But if you think there will be a nationwide home crash, it's possible, but with $2 trillion deficit, there is a commitment to devalue the dollar. That is a tailwind to home prices. Not only that, but over $1 trillion was given to savers last year from the federal government. We have to remember that's stimulus money. And many of those savers, even if they're international, they're U.S. investors. They're going to invest in something. That's not me saying real estate's going up. There's a lot of puts and takes. My point is, though, it's probably not going to crash. There's just too much money, too much spending. Even if we get home prices to drop this year, I just don't see a crash in the cards. The U.S. government is paying delinquent mortgages. Banks are extending and pretending. There's a lot going on to keep this housing market afloat. With the commitment to devaluing the dollar, I want to take you to an extreme example. Now, before I share this example with you, I want you to know that I don't think this is the U.S., but I do think in extremes to help me extrapolate what could happen next. So, if we get a federal government that pushes for artificially low interest rates, which, by the way, could still be 7% mortgages, but if they push for artificially low interest rates, and we see the deficit spending continue as inflation increases. Look at Turkey. They did the same thing. Their stock market 5x'd in 2 years. Again, I'm not saying we're Turkey, but I am saying there are some similarities that we could take from what's happening in other high inflation countries, and we could apply it here. Whether you think the tariffs are a one-time adjustment or you think there's a permanent new wave of inflation like myself, the bottom line is that the housing market's extremely uncertain. A crash, while possible, is much less likely, in my opinion. Inflation and a much more flat housing market as incomes and wages catch up with inflation, to me, is more likely scenario, but I don't eliminate any possibility.
As I said before, keep your eye on one thing and one thing only, how much government is spending, because that's the true tax. Every budget is balanced. There is no such thing as an unbalanced federal budget. You're paying for it. If you're not paying for it through it in the form of explicit taxes, you're paying for it indirectly in the form of inflation or in the form of borrowing. The thing you should keep your eye on is what government spends. And the real problem is to hold down government spending as a fraction of our income. And if you do that, you can stop worrying about the debt.
Now, I'd love to hear what you have to say. And with that, I appreciate your time. I hope you all have a great weekend. I look forward to seeing you next Saturday. Thanks a lot.